We began talking this morning about taxes with our farm tax specialist, J.C. Hobbs, who's worked for Extension for a long time. We've heard a lot about the reconciliation bill, or the big beautiful bill that passed recently, and we want to kind of dive into a few topics, starting with some of those personal items and how taxes might be affected there.
Okay, so really the biggest thing that happened was the standard deduction has been retained. Now, the reason we talk about this is 2017, with the Tax Cuts and Jobs Act, we ended up with some major increases in the standard deduction, as well as a few other things. Well, that was supposed to sunset next year, 2026. It's been retained, so a married filing joint gets about a $26,000 standard deduction, singles about $13,000. And it originally was going to go back to about $6,500. So there's a big piece there. But what that did cost us was the personal exemption. So when the Tax Cuts Jobs Act passed, personal exemptions were eliminated, but they were supposed to come back in 2026. Now with the big beautiful bill, it's been permanently repealed, so that is now gone. So the other thing that was a big deal, we're talking about doing away with taxation on Social Security. Well, that didn't fly very well, so for seniors 65 and over, for the next, I believe, 3 years, they're going to get a $6,000 per individual, it's over $6,000, deduction or reduction, whatever you want to call it, benefit, and then that will go away, I believe, starting 2029.
Another big thing that people are keeping an eye on are estate and gift taxes.
That was a major fear,
Right.
because the Tax Cuts and Jobs Act, when it passed, it doubled the amount of the estate tax exemption, and currently it was about $15 million per individual for 2025, and then it was going to go back sunset to half of that beginning in 2026. And everybody was afraid of what that was going to do, because with the 15 million, that exempts most farm and ranches real quick, and with a husband and wife being able to share that, it goes up to 30 million. So that has been retained, and it has been made permanent. It will not go away. And it's going to be indexed for inflation, so it's going to keep getting larger. So small businesses, farms, individuals, husband and wife, $30 million, estate tax exempt. Not going to have to worry about that. So that is a major piece of that puzzle. And everybody was all worried it was going to revert back. A lot of questions came to me, but this big sigh of relief came about with the retention of that.
Let's talk about another thing that really affects farms and ranches in Oklahoma and obviously around the country are depreciation changes.
Right, two big ones. One of them was for the bonus depreciation, and that was supposed to go, it's been ratcheting down the amount that you're allowed. This year, when we started the year, it was at 40% of qualified purchases would be allowed as a deduction, so as a depreciation deduction, above and beyond normal depreciation. And once the president was inaugurated, it went to 100%. So you could write off 100% of the purchase of qualifying assets, those assets with a useful life of 10 years or 20 years or less. You can write off 100% of that purchase price against taxable or against farm income. So all of a sudden now we got another great ability to manage taxes. And then on the other side, the Section 179, that's an expensing rule, and it works just like depreciation, except there's a little bit of a different nuance. From the standpoint, bonus depreciation offsets all income. Section 179 only offsets farm income or business income. So with the passage of the big beautiful bill, that went to 2.5 million. What that means is a farmer or any business can buy $2.5 million of assets in the current year and deduct 100% of that against their business income. But it can't create a loss. But it's only for business income, whereas bonus offsets both business and non-business income. So between the two of them, you can do a little bit of manipulation, and you can really do some tax management planning, in which farmers are probably going to need. Some of the ranches have had a great year with cattle. Others have not done so well, but for the most part, this is going to be around. Both of them are made permanent, the 100%, as well as the larger 179, and the 179 is indexed for inflation, so it'll keep getting larger in the future as well.
So this is a lot to keep track of, right? And we're only scratching the surface today.
Right.
You and Dr. Hagerman, who's on our show frequently, are going to work on some educational programming through Extension throughout the year.
Correct. Yeah, we're already talking about how do we best do this with some fact sheets, just kind of outlining the bits and pieces. And also I'm be working with tax preparers this fall, trying to educate them on the nuances of the big beautiful bill as well and how to apply those.
So it's good to talk about some of this now so we're prepared, but the real work comes at tax deadline in the spring.
The real work comes a little bit later this year. When we really start talking October, that's the best time to start doing tax planning.
Okay.
Look at where we're at, what can we do to manage our tax bite, because the idea is we don't want to minimize taxes, we want to maximize after-tax net income, and that's why tax planning is very important.
Lots of great information today and more to come, and we're glad to have you on anytime, JC, to talk more about taxes.
Thank you very much for inviting me.